The British pound remained above $1.34 after UK GDP data came in line with forecasts, providing some relief to Finance Minister Rachel Reeves ahead of the government's November 26 budget. The UK economy grew 0.1% in August, rebounding from a 0.1% contraction in July, led by manufacturing, while services were flat for a second month and construction fell. However, an annual expansion of 1.3% is insufficient to offset the need for tax increases. Reeves recently signaled she is considering tax hikes and spending cuts, with the government likely needing to raise around £30 billion amid rising borrowing costs, scrapped welfare cuts, and weaker growth forecasts. On the monetary policy front, traders have increased bets on Bank of England rate cuts next year, even as the IMF cautioned that inflation is expected to remain the highest in the G7 through 2026, advising the BoE to proceed carefully. The FTSE 100 fell nearly 1% on Friday, marking its worst day since April, as renewed worries over U.S. credit markets triggered a global sell-off in equities. Losses at two U.S. regional banks linked to loan fraud raised fears of broader financial stress, unsettling investors worldwide. Barclays fell more than 5%, HSBC Holdings and NatWest dropped 2.8%, and Lloyds Banking went down 1.9%. Still, sentiment improved slightly later in the session after positive trade developments helped U.S. stocks recover and caused gold and silver prices to drop. Precious metals miners led declines, with Fresnillo, the index's top performer this year, down 11%, and Endeavour Mining off 6%. On the upside, Man Group and Pearson gained after upbeat reports, with Pearson rising 2.5% on stronger third-quarter sales and promising progress in its AI learning tools. Meanwhile, Bank of England chief economist Hugh Pill cautioned against cutting interest rates too soon. The UK's annual inflation rate held steady at 3.8% in August 2025, unchanged from July and remaining near the highs last seen in January 2024, in line with expectations. Inflation slowed for transport, 2.4% vs 3.2%, with prices for fares falling 3.5% and making the largest downward contribution. Inflation was also lower for services, 4.7% vs 5%, recreation and culture, 3.2% vs 3.4%, and clothing and footwear, 0.2% vs 0.3%, and steadied for housing and utilities, 7.4%. On the other hand, the largest upward contribution came from motor fuels. Inflation accelerated for restaurants and hotels, 3.8% vs 3.4%, food, 5.1%, the highest since January 2024, vs 4.9%, and furniture, household equipment and maintenance, 0.8% vs 0.7%. On a monthly basis, the CPI rose 0.3%, following a 0.1% gain in July and matching forecasts. Annual core inflation eased to 3.6% from 3.8%, matching forecasts. The United Kingdom's unemployment rate rose to 4.8% in the 3 months to August 2025, above market expectations of 4.7% in July. This marks the highest reading since the 3 months to June 2021. The increase reflected a rise in the number of people unemployed for up to 6 months and over 12 months, while those unemployed for 6 to 12 months were largely unchanged. On an annual basis, unemployment rose across all duration groups. Meanwhile, the number of employed individuals grew by 91,000 to 34.2 million, driven mainly by gains in part-time roles and employees aged 65 and over. The number of people holding second jobs decreased slightly in the quarter but rose over the year to 1.323 million, representing 3.86% of total employment. Lastly, the economic inactivity rate remained broadly unchanged at 21%, 0.1 percentage point higher than in the prior period. The Bank of England voted 7-2 to keep bank rate unchanged at 4%, with 2 members favoring a 25 bps cut to 3.75%. The MPC also voted 7-2 to slow quantitative tightening, reducing gilt holdings by £70 billion over the next year to £488 billion. Policymakers highlighted progress in disinflation after past shocks, supported by restrictive policy, though inflation remains above target. CPI stood at 3.8% in August and is expected to rise slightly in September before trending back toward 2%. Wage growth, while still elevated, has eased and is forecast to slow further, while services inflation has remained steady. The MPC flagged upside risks to medium-term inflation but noted subdued GDP growth, a loosening labor market, and slack in the economy. Looking ahead, the committee stressed a gradual, data-driven approach, with no preset path for rate cuts, keeping flexibility to respond to future developments.